Hello, everyone, and welcome to the Weekly Watch. I'm Brian Daingerfield, the co-head of G10FX Strategy at NatWest Markets, filling in for John Briggs. It may be difficult to believe, but 2022 is already halfway over. And as we look ahead to the second half of the year, it certainly looks like it could be a challenging one. Monetary policy authorities across the world have tightened monetary policy aggressively to fight against runaway inflation. But recent economic data, especially in Western economies, suggests that there may be signs of slowing on the horizon. And so that combination has fueled concerns that central banks may be over-tightening into a storm. But recently, China has emerged from COVID-19 related lockdowns, and some of the economic data there have turned higher. Recently, PMIs moved back above 50 in China in the latest month. So to talk more about the themes in China over the latter half of the year, I'm happy to be joined by Galvin Chia, our EM strategist. So Galvin, welcome. Thank you very much for joining us.
Hey, thanks, Brian. Thanks for having me.
So Galvin, let me just ask you first about the overall themes in China for the second half of the year. What do you think are some of the core themes that we should be watching in China's economy and the currency in the second half of 2022?
Yeah, for sure. I think really the key questions surrounding the Chinese outlook centers around this idea of a policy trilemma that we've been talking about, over the last couple of months, right? And it's sort of a pick two out of the three scenario. And I think how, which two sides of this trilemma triangle that sort of end up triumphing over the course of the next couple of months is really going to shape the outlook for, I think, not just like sort of domestic Chinese assets and the domestic Chinese economic outlook, but it's going to have repercussions around the world as well. So let me walk you through some of what we've been thinking about. On the one hand, there's sort of the overarching growth target that the Chinese government had for 2022, and that was achieving a full year growth of about 5.5% of GDP. On the other side of the triangle was this, fairly strict COVID zero policy, whereby there's, no mention of living with the virus, clamping down and resorting to quarantines and those sorts of, isolation measures whenever you have a flare up in cases. And on the other side, you have, this idea of deleveraging. The Chinese economy, Chinese authorities rather, want to maintain this course of sort of trying to deleverage, lower loan and debt ratios in the economy after, what they saw was a pretty risky buildup in the mid-2010s. But judging by that, the way we're thinking about it is that you can only sort of pick two out of those three. COVID policies are restricting a lot of the domestic economic activity, and as we saw during the Shanghai lockdowns, also went a fair way to disrupt global supply chains as well. On the deleveraging side and the growth target side, we've come to acknowledge that with the sort of structural slowdowns that have been affected the Chinese economy over the last couple of years, coupled with the on and off nature of these lockdowns, that's resulted in a growth target in our growth projections, fairly far away from 5.5%. It's not a rounding error. Our China economist Pei Tian, she puts her her current growth targets are around 4.2% for the year. And the consensus estimates are between the high 3 and low 4s, right? So a fair way away. And I think on the other side, it's widely acknowledged that we can't make up the difference in growth without really juicing the economy, through credit, through fiscal stimulus, or through monetary stimulus. All in all, that would entail some form of re-leveraging the economy, particularly if that's going to come through, the sectors of the economy that can really deliver on growth, namely housing or infrastructure. So I think, depending on how we emerge over the next couple of months, that's going to really shape the way things turn out. So as of now, as you mentioned, we're starting to see a little bit more pickup in the economic sentiment coming out of the lockdowns. And we're also starting to see a little bit more sort of clarity around what they want with COVID restrictions. Now, this means that instead of, quarantining for up to 3 weeks in some cases, it's now around 10 days if you sort of are inbound into the country, or if you're a close contact of someone with COVID. That's still very far away from living with COVID like you might know it in in the West, in the US, or where I am in Singapore, right? But on the and so on that front, it's sort of a glimmer of hope, but we're definitely not anywhere close to getting away from COVID zero, right? So I think really it's the combination of how these three factors interact that's really going to determine what the second half is going to look like for the Chinese economy.
So I think one of the good points you bring up, and really to contrast that with a lot of other economies in the world, is that China's grappling with the question of whether or not to try and encourage leveraging, encourage credit growth, while pretty much every other economy in the world is trying, to take policies to discourage that type of activity. So really sort of shows, where we are in the relative policy cycle when thinking about China. You mentioned that the recent loosening of the guidelines around COVID-19 quarantines, that's probably not a move away from zero COVID strategy. So it feels like this is going to be something that overhangs us into the upcoming leadership conference. Is that right? Is that something that you feel like is going to remain a risk around, the possibility of renewed lockdowns?
Yeah, absolutely. I mean, I think for the most part, yeah, I would agree. I think on the idea of, like this sort of the question of lockdowns, I think what we've come to realize is that what this clarification in the policy, the streamlining of this COVID policy from what was, really like a local, locally differentiated, mishmash of approaches, was that you're probably going to avoid a sort of overzealous implementation of quarantine like we saw, in parts of Beijing and like we saw, sort of infamously in Shanghai. So our view really is that you probably won't see that sort of a massive lockdown, that sort of a massive shock to economic activity and to life in general, right? That's what this policy is going to do. So that's how it's going to sort of, on the margins, you can see that's why it's good for sentiment. It's slightly better, for planning and forward thinking, investment and consumption decisions, right? But that being said, I think so much has been sort of intertwined with the messaging and the politics of this current this current generation of leadership, right? And as we all know, President Xi Jinping is aiming for this very very rare third term in Chinese politics, the third 5-year term. Now, again, so much of that has been locked up in the political messaging, in the sort of the government's policy objectives, that I don't think we're going to see any sort of move away from COVID zero anytime soon before the party congress later this year, where that planned transition from the second term to the third term is going to happen, right? And I think at the same time, to think about not just from a political perspective, but also like a sort of epidemiologic, from a vaccine perspective. It's been a long time, still haven't been able to, say that word. From a vaccine perspective, we have primarily, the vaccine coverage, if you recall, in China has been Sinovac, which is not an mRNA vaccine, right? The vaccine take-up has been about, in the high 80%. I think the precise figures are not easy to find. High 80%. But in a country of 1.2 billion people, that's still a fair amount of people who are not fully vaccinated, right? And as we've seen, with, if you recall, right, like casting our minds back a couple of months, with the new variants of COVID, they're not particularly deadly, but they are transmissible, right? And so I think from a Chinese, health protection standpoint, that really, constrains their degrees of freedom when it comes to resuming, regular life, without masks or, 100% freedom of movement.
So it certainly feels like the picture in China remains a difficult one, a difficult balancing act. But at the same time, you have seen a real improvement in sentiment on, in terms of coming out of lockdown. But what I find notable is that the dollar CNH exchange rate has really remained essentially steady closer to its highs. As we saw earlier this year, when lockdowns really started to accelerate, dollar CNH rose pretty dramatically off of its lows. But rather than come lower, it's actually kind of stabilized here, despite the fact that it seems like sentiment has improved. What are some of the things you're thinking about the exchange rate, and what are the themes you think are pretty relevant on that front?
Yeah, so I think that's a really, really good question. I think overall, in terms of where we think, the currency is going in terms of levels, where it's currently, as we talk, trading at around the 670 level, or last I checked. And I think, in terms of our views, it's probably going to range between, like sort of the 660 to 680 range. And again, that's a very in ordinary times, that would be a fairly large range. But I think relative to what we saw over the last couple of months, that's incredibly narrow, right? After this huge spike in volatility that we saw, I think it's worth considering. Let's say from a couple of standpoints. On the one hand, China's exports are still doing reasonably well. You'd expect the growth numbers to sort of start to even out a little bit as as the world comes out of this sort of COVID-induced slump and subsequent stimulus-induced sort of demand frenzy, right? So I think that side is not growing as fast as it used to, but it's still, the export numbers are still looking incredibly good, right? Very, and very much above the pre-COVID trend. So that's going to provide a fair amount of sort of a dollar income for exporters to want to sell into CNY. On the other hand, the other thing that's kind of really an interesting turning point that's been happening is a fairly unprecedented exodus of foreign capital from the bond markets. We saw, I think it was 4 consecutive months of exit, and the previous record really was only 1 month of exit. Typically, the inflows that you saw consecutively, and the trend was inflows, not outflows. So I think on the other hand, if you think about it from the portfolio perspective, like portfolio flows perspective, equities have remained fairly volatile and have actually sort of in the last couple of weeks recouped all of the outflows that we saw over the last couple of months, because Chinese tech stocks right now have very strong momentum and are hot. So I think overall for us, it's a fairly balanced outlook. And I think in terms of the day-to-day drivers from what we've been seeing, or week-to-week drivers, the domestic local stories have really failed to move CNY, CNH to any appreciable degree. The currencies haven't really been tracking the changes in portfolio flows very well. They haven't really been reflecting the trends in exports. And so our thinking right now is that it's really, as with so many other currencies at this sort of very volatile juncture, they're really being driven by external factors. So things like, what's the outlook on US inflation? What's the outlook on the Fed? What are bond yields in the fixed income markets doing? That, in a sense, is helping to drive the sentiment around dollar CNH a lot more than any of these domestic factors are.
That certainly makes a lot of sense to me. And, think about what type of environment might cause fixed income outflows, and monetary policy divergence is probably towards the top of that list. You talk about China being in a mode where they would be considering needing to ease in order to help support demand through lockdowns, while the Fed is doing, of course, the exact opposite. So it certainly makes sense to me that the broader global dollar, what's going on with global growth, is going to have a pretty important impact on dollar CNY. I did want to change tacks a little bit here and talk a little bit about one of the potential external drivers that haven't done a lot of driving recently, but that is on the trade front. And I will say, from the US perspective, there has been some discussion of whether or not there would be some strategic easing of tariffs on Chinese goods. The US has been a little bit cagey on this, where on one hand, they've been talking about whether or not that would provide some relief on the inflation front. But U.S. Trade Representative Tai was pretty blunt recently when she said that the tariffs are leverage against China, and that you don't give away leverage for nothing. And so it certainly feels like the U.S. is considering moving in that direction. Do you get the sense that any relief on the tariff side would be positive for the outlook for China, and how local assets might respond if the U.S. were to either take or sort of eschew that kind of move?
Yeah, I think it's actually quite a difficult question, like you said, because so much as well is changing on the financial and monetary side, but also, the sort of policy environment that we're in now is also quite different. I think, if there is a sort of appreciable easing of these tariffs, you definitely, of course, would expect local assets to appreciate, to rally, right? And I think that's a natural sort of a headline. That would be a natural headline-driven move. But I think I get the sense that the overall regime that we're in now is quite different now. When we were in the Trump administration, so much of, for example, so much of financial markets was driven on a tweet-by-tweet basis. Never mind questions about policy efficacy or potential impacts and second and third round effects, right? I think now that the Biden administration is back to as you and I mentioned, Brian, back to building back boring as opposed to tweeting tariffs. It's probably going to have less of an immediate impact as well. And I think on sort of the Chinese side as well, there is a little bit more of a wariness towards I suppose, they've been once bitten, twice shy, right? But not just from the US experience, but also noting the experience from, what has been one of their close diplomatic allies, Russia. So I think on that side, there has also been a slow wariness and attempt to increase some of the buffers that they would like to have, just in case, the US should come around and try to, as you said, try to leverage China using some of this tariffs.
Thank you very much, Galvin, for joining us. And thank you for listening. If you liked this podcast, please be sure to remember to like and subscribe to the Weekly Watch to receive additional content. Thank you.